Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Defiance Silver.
Be careful if you own US dollars or euros, warns Alasdair Macleod. He is head of research at Goldmoney. Alasdair, welcome to Kitco.
That's very much my pleasure, Mike.
Alasdair, a lot happened this week. It is the first week of May. We may be in a pause right now with the Fed, with its last 10th consecutive interest rate hike. We have the strong jobs number that came out on a Friday, slightly stronger. So if you have a data-driven Fed, it might actually be forced to raise interest rate more. Take us through it all. Where do you see right now what is happening?
Well, there is this sort of, very ingrained belief that the Fed controls interest rates. Under certain circumstances, it can, yes. But we now have a situation where banks are becoming risk averse. They're becoming risk averse both in terms of purely financial activities, and I think they're beginning to become risk averse in terms of non-financial activities, and I'm talking principally about lending. So what we are seeing, and we've already seen a bit of this with money supply statistics, we're beginning to see M3, M2 beginning to contract. Now this is very serious. What it means at the end of the day is that on the lending side of banks' balance sheets, they are withdrawing credit. Now, when this happens at a time when the economy is slowing, companies tend to need more credit facilities because the sales are a bit disappointing, they got inventory buildup, whatever it is. So you've got this clash of banks trying to withdraw credit, reduce their balance sheets, which have become over-leveraged really over the decades. And at the same time, you've got increasing demand for that credit. So what happens? Interest rates rise. It's as simple as that. And so the idea that we should be watching the Fed and this is the last rise, the Fed can make the Fed funds rate what they want. But the reality of the situation for businesses, for dealers in the market, is the availability of credit is contracting. And if they want to continue to deal, they're going to have to pay up. So that, I think, is a very important point because it makes the funding of government debt in the United States doubly difficult. And at the same time, the foreigners own an awful lot of dollars and an awful lot of dollar assets. If you work off the Treasury's own figures, the tick figures, deposits and short-term Treasury bills, commercial bills, there's a total of just over 7 trillion in foreign hands. If you look at what the Americans, residents, hold in terms of foreign currencies, that's only 380 billion. So you got 7 trillion, 380 billion. They start selling down that 7 trillion, you've only got 380 trillion to exchange for it. Now, obviously that's not the way it works. What will happen is that the swap lines between the central banks will be increased and the central banks will intervene in the markets. You've got a further problem, and that is that the Fed itself ramped up Treasury bond prices by smashing the yields and paid top dollar for buying US Treasury bonds, agency debt through quantitative easing. Now, we know that some of the regional banks have got themselves underwater doing a similar thing without, if you like, the benefit of having the printing machine to to pay for it, in quite the same way. But the Fed also has these losses on its own balance sheet. And we know this. Various writers have pointed out that this could amount to $1 trillion or whatever. Now, we all sort of think that the central banks, it doesn't matter if they're in negative equity. In other words, the equity is wiped out completely by the losses. The Fed will say it's holding the stuff to maturity, and indeed, most of the time it is. But nonetheless, if this was marked to market, the Fed is basically bankrupt. So is the ECB. Now, when it comes to refunding the ECB, there's a problem. I mean, I can tell you very quickly how to recapitalize a central bank. On the asset side, you create a loan to the government. And then you rebook it on the liability side, not as a deposit, but as equity. Voila, you've recapitalized your central bank. You can do that, that's easy. But think how it works with the ECB. The ECB is a very different situation. Its shareholders are all the national central banks within the euro system. They in turn are deeply in negative equity. So just imagine Bundesbank, it's got to go to the German parliament for enabling legislation to recapitalize itself, and so it can also recapitalize its share of the ECB. Now, I can see on the floor of the parliament, I can see politicians, not really versed in these affairs, asking a very sensible question. Well, Bundesbank, you tell us that you need to raise €1 trillion, for which you want authorization. But you wrote 1.1 trillion through the Target 2 system. Why can't you use that? Oh my goodness. You've got to now explain what that is. And do they really know what it is? They don't know. There's this huge amount of imbalances in the system which was never meant to exist and all the rest of it. We're opening a can of worms with the ECB. That is the point. So I actually think that this sort of contracting credit, which is also now happening in the Eurozone, could actually demolish the whole Euro system. It's not just a problem for the commercial banks. And even in the case of the Fed, without that recapitalization, we look to the Fed to underwrite the whole of the commercial banking system in America. Because you cannot afford depositors, if you like, to lose out. This idea that the FDIC protects you to $250,000, I mean, they've got to protect a lot. Because if you don't do that, then you're going to get ripple effects, you're going to get money moving. You're going to get the whole of the regional banking system, whether they're good or bad, finding there's a run on them. And so, basically we got problems, and that was the short term. Can I indulge you with a little bit of commentary on the long-term investments? Investments which, as far as the US Treasury are concerned, owned by foreigners with a maturity of more than 1 year. The foreigners own 24.5 trillion, made up of US Treasuries, corporate debt, and equities. A lot of this is obviously portfolio stuff. Now, we're going to get rising interest rates, which means we get rising bond yields, which means we get falling bond prices, which means we get falling equity prices. That is the prospect. It's not my forecast, that is the prospect, and it's a pretty clear prospect. Now, under those circumstances, we've got to think what the foreign exchange implications of this are. The other side of this deal is that US residents own roughly 14.5 trillion of foreign investments. So the gap is around about 10 trillion. Okay. Now you might think that's not too much of a problem, but bear in mind that the ownership of foreign assets is almost all in ADR form. In other words, there is not a foreign exchange transaction required when you sell, say, New York listed shares in Deutsche Bank or whatever it might be. You're just going to sell them on the New York Stock Exchange, and there's no foreign exchange transaction at all. The arbitrageurs may do something, but that's not what we're talking about. So, but on the other hand, of that investment in foreign equities, foreign bonds and all the rest of it, the 14.5 trillion that the Americans own of foreign stuff, that does involve a foreign exchange transaction. Sorry, the other way around. The foreigners owning US treasuries. So in other words, what we're looking at is of the 24.5 trillion, that is all involves foreign exchange transactions unless they build their dollar position, which they are not doing. So you can see that the potential for a massive run being triggered by foreigners in the dollars, I think is very, very substantial. And this is worrying because this is larger than anything that can really be contained by central bank action or the action by the Treasury trying to deal in foreign exchange markets. The Exchange Stabilization Fund, which was this is meant to do this sort of thing. And the problem is that while domestic residents, Americans in the domestic market don't actually appreciate these dangers. There's no reason why they should see it, but you've got to put yourself in the shoes of a foreigner. The foreigners are now definitely winding down their dollar interest. They're worried about the banking system. They don't really want to have, if you like, the currency risk as well. You have seen quite a large number of countries now talking about settling their international trade in currencies other than the dollar. The yuan obviously hits the headlines, but there've been other stories as well, and they were all sort of, if you like, wound up to understand this problem when Vladimir Putin stood up at the St. Petersburg International Economic Forum last June and said, "Why hold dollars? Why hold euros when they can just take them away from you? Why hold these when the inflation rate at that time was 6.5%, and you're only getting 3.5%, which was the Fed funds rate at the time? You're on a definite loss. Why store your bullion? Why store your gold, which is the only proper money in vaults amongst the unfriendlies, as he calls us?" And there were 81 official delegations at that conference. And there were 14,000 attendees, including a lot of government officials attending unofficially or not in an official capacity. So the rest of the world has been warned, if you like, of the conditions which now seem to be coming true. Don't ask me how long it's going to take for this really to happen, but I think any apparent reprieve on the interest rate front is likely to be very, very small. I think it's just a window of opportunity, perhaps, because I see them rising again. Why? Because banks are contracting credit, and that, of course, leads to further banking problems. It's a mess. It's an absolute mess, Michael.
De-dollarization. We had this theme going back a year ago with the outbreak of the Ukraine-Russian war, and then some of the first tools that were used were financial controls that were placed on the antagonists, Russia, for instance. How has that played into themes of what is people say is the move away from the U.S. dollar?
Well, it is now playing in. This is the point really I'm making, that the dollar is overowned by foreigners, and they're now seeing the conditions whereby this is heightened risk, and so they're getting out. As to de-dollarization, of course, it's very much an ambition of China and Russia as the ringmasters, if you like, for the whole of Asia and the Shanghai Cooperation Organization, to do away with the dollar for inter-Asian trade, if you like. And that is also extending to a lesser degree into BRICS, which broadly we can summarize as the nations outside Asia which supply Asia in terms of commodities and a bit of trade and so on. So the de-dollarization business is happening. Now, it's not China, it's not Russia drawing it. Their strategy is not to, if you like, destabilize the Western financial system. Their strategy is to stand back and let the West destabilize itself. And okay, they've given a little bit of a nudge in the right direction with that St. Petersburg conference with Putin's comments. But basically, they are not contributing to our problems by actively seeking their objectives. And it's, the only time there has been any move which you could say was an initiative on their part was what Putin called the special operation, the attack on Ukraine just over a year ago, and particularly refocusing on the eastern provinces of Ukraine and protecting its access to the Crimea. So. And other than that, they've started, because the problem is they don't want to give the unfriendlies, us in other words, the excuse to attack. It is desperately important that we get ourselves into the mess. They're not involved, they're bystanders. And if they take any action at all, it is purely protective. And it could be seen as such. I think the Americans would, love to see, if you like, a reason to really escalate this situation. But they've got to, the reason has got to come from either China or Russia. And you can see they're trying to provoke China over Taiwan. China, to an extent, sort of rather gone along with the provocation. That's an interesting one because it's actually very easy for China to solve. You just go along to Taiwan and say, well, come on, let's calm this down a little bit. In the long term, in the very long term, we would like to reunite. But meanwhile, why don't we trade with each other? And that would diffuse the whole thing. I wouldn't rule it out as a possibility. But then when I look at the Middle East, this is a real problem, I think, for America. You've got the Fifth Fleet in the Indian Ocean. They sent a nuclear attack submarine, the USS Florida, through Suez about 3 weeks ago. William Burns of the CIA visited Riyadh. Now, what was going on there, I think, is that you've got pressure beginning to build against Saudi Arabia and against the Gulf. Now, I think the real target is probably Iran. I think what America's Fifth Fleet will want is provocation. They want to provoke something, and so they can respond. And the provocation could well be as simple as evidence, so-called, of Iranian developments on the nuclear front. But the reason I don't think this is really going to happen, I think this is part of the planning that's going on, it's one of the options, but the reason I don't think it'll happen is because William Burns would have been told in the visit to Riyadh that if they do anything, then Saudi Arabia is their enemy as well. In other words, they can't rely on any support within the region, which of course the Americans need because, if you're going to attack someone, you've got to have the others supporting you. But already we've seen with since Mohammed bin Salman effectively kicked the West out of Saudi Arabia, peace has returned. Diplomatic relations are being exchanged with Iran. President Assad of Syria is going to visit Riyadh in the next month or two. The first round of talks with the Houthis in Yemen has been successful. I think Bahrain and the United Arab Emirates, or was it Bahrain and Qatar, who broke off diplomatic relations, they've restored them. Peace is returning to the Middle East now that we've been kicked out. And that, I think, must be upsetting to the planners in the deep state.
Alasdair, why are Western economies hampered by reliance on service sector economies?
Well, that's actually quite a hard question to answer, other than to say that a well-founded economy has a strong manufacturing centre. But that only comes if you've got a decent savings rate. In other words, if people actually put aside money to save. But both America's economy and the British economy now depend on consumer finance rather than consumer savings. So we don't actually have the capital backing for financing industry. And not only that, but anyone trying to build a factory, say in the UK, how long does it take to get around the planning regulations and all that? The answer is you can do this far quicker abroad. So we've hollowed out our economy, as it were, from the real stuff. Now, Germany here, where we are in Frankfurt, Germany has been very different. They've got called a Mittelstand, but that's backed by genuine savings and has been all the time. The tragedy, perhaps, is that these savings are being diverted through the euro system into excessive debts, particularly amongst the Club Med, the Italians, the Greeks, the Spanish, and so on. So Germany is in a difficult position, but it's the countries, I think, with service industries, and I've got nothing against service industries, but what you've got to have is you've got to have some sort of balance in the thing. Service industries, we've gone that way because it's just so much simpler with all the restrictions around, which add cost to production. The idea that you need to have cheap labor and all the rest of it to have effective production, I'm sorry, it doesn't actually cut the mustard because the real killer in investment is time. And in a country like the UK or the US, if you want to build a factory, in most cases, you're looking at very extended timescales, with all the permissions, all the regulations, and you've got all the regulations too. I mean, it's ridiculous. We're chasing away businesses due to regulations in the UK. What are we doing about it? We're sighing, and that's it. We don't do anything. So as to the importance of service industries, I mean, it's a skill set. Of course it is. America's got more lawyers, I think, than almost anything else. But, in terms of real production, I mean, you've got to have a basis of real production. I think that is the point. So real production first. Services, yeah, okay, that's contracted out from real production. It shouldn't be sort of standalone in a sense. I mean, though obviously, you've got accounting, you've got lawyers and all the rest of it, and we're all inflicted with them, I'm afraid.
Now, Alasdair, we're at Deutsche Goldmesse here in Frankfurt, Germany. One of the exciting pieces of news that has been running through the conference is the Newcrest Newmont potential deal right now. So the number 1 gold miner, Newmont, potentially acquiring number 8 gold miner, Newcrest. There's been some, and what we have been looking for in the gold sector that people have been asking for a long time is some type of consolidation, how would you say, pulling together synergies. We need to have some more champions. We have some consolidation, though, that is happening in the US out of the financial crisis, and then that would be some of the smaller regional banks that are being swallowed up by some of the larger banks. And so one of the most recent examples would have been Silicon Valley Bank that is now having to give itself up to JP Morgan. If consolidation is good enough for the gold mining sector, why isn't consolidation good enough for the banking sector, Alasdair?
Well, is consolidation good for the mining sector? Well, it sort of introduces a bit of interest, I guess. But I think if I can just say something about the mining sector, we're very much focused on our own troubles. Yeah. And it's very easy for mainstream media, for economists in the investment banks to say, we face a recession, it could be worse than that, and that means demand for minerals are going to fall, and therefore, mining sector, forget it, sort of thing. It's very easy to take that view, but it would be a wrong view, because we are 1.2, 1.3 billion people on the planet. We advanced people. China and Russia are advancing 3.8 billion people into a new industrial revolution. I mean, it's a process which has already started, but it's going to continue and accelerate. I mean, interestingly, as a token of this, while our bank shares have been crashing, I don't know if anybody's noticed, but the bank shares of the Chinese global systemically important banks, of which there are 4, have been rising. It's a completely different outlook. The Chinese economy is actually beginning to do pretty well. It's recovering from COVID and all the rest of it, and they're now planning for a future. I don't like the Chinese government. I don't like central planning, but they have a plan and they're determined to pursue it. And what this means is that demand for minerals of all stripes is going to increase very, very substantially. So I think that the interest will come back into the sector. And I don't think it requires, sort of major consolidations to generate that interest. That's the first point I would make. Turning to the banking sector, I think the regulators would like to have very few banks to deal with. We've seen that trend. They like sort of consolidation. They don't like small banks in pockets which are probably not being observed that much. It's a sort, because regulations are a tick box thing as much as anything. And regulators certainly don't understand the business they're regulating, because they're not entrepreneurs. Bankers are entrepreneurs. They're dealers in credit, and that's essential. But the point I would make about regional banks is that, look at the economy. It's 80% small and medium-sized businesses up and down the nation. It's the same in America as it is in the UK, as it is in Europe. You've got all these sort of behemoths who capture the headlines, but actually the economy is vastly dependent on small and medium-sized businesses. And these businesses need financing. And the only way it's economic to finance these businesses is through smaller banks. So to do away with regional banks, to do away with smaller banks, is a great error. It means that the process of creating credit becomes refocused onto the big businesses, and it is taken away from the small businesses. And I think that's one of the reasons why our economies are just stagnating. The credit finance is not being made available, even in good times. I mean, now of course it's changed. Everybody's trying to, reduce their balance sheets because they're over leveraged. But as a matter of principle, I think that regulation is driving our banking systems in totally the wrong direction.
Alasdair, I'll thank you very much for taking the bullish views on what is happening with metals and that we see brighter days ahead for what's happening in mining. The one thing that I have difficulty though with is that the outlook for recession. So we have copper, which everybody's been very excited about in this space. You look at mines that are declining, and then certainly all the story around energy transition. But it seems that copper is very much wedded to what is actually happening in the larger economy. And right now, looking at the forecasts coming out of the Fed, looking at the way that the charts are working right now, it seems that we are headed to recession. Dr. Copper is going to be following its way down that. We see the same thing also that is happening with oil, which is, we were promised triple digits, it seemed like last year. But when I looked, we see at $60 oil right now. If the outlook is for recession right now, it seems certainly like a hard look for the base metals and other people around them.
Yeah, well, as I said earlier, I mean, when we talk about the recessionary outlook, we're talking about us 1.3 undesirables, the Western Alliance. But there's a bigger world out there. I mean, we're literally splitting off. You got us, we're going to hell in a handcart, and you got the rest of the world, which actually has got wonderful prospects. I mean, Africa, on the back of Chinese investment, admittedly to a large extent, has got tremendous growth potential. India, see what's going on there. It's absolutely remarkable. They're very much tied in with this Asian evolution, revolution, industrial revolution. And of course, China itself. I mean, China has really got over its property problems. I mean, the tales last year or earlier last year were you got a property crash in China, etc. The developers were going bust and all the rest of it. Okay, they've gone through that. But the great thing which China has, which we don't have, as to your point about manufacturing real things as opposed to services, is that China has the most incredible savings rate. The average savings rate out of taxed income is 40%. In fact, slightly over 40%. And what this means is they can expand credit without it fueling consumer prices. If you look at the consumer price inflation in China, it's around about just slightly less than 2%. Compare that with us. I mean, in the UK, we've got the retail price index is up by 14 or 15%. We've got 10% inflation on CPI. Okay, it's coming down because some nasty figures are coming out of the back end of the statistic, but the idea that we're dealing with our inflation problem, we're going to go back to 2%, forget it. We've got the problems, not the rest of the world. And we are only 1.2, 1.3 billion out of a total of around about 7.5 billion. So I think the answer to your question is, when we look at Dr. Copper, we've really got to look towards that Asian demand. And when it comes to short-term trading and all the rest of it, I can't comment on that, but I just feel instinctively that with their plans, and if they can carry them out, and I'm absolutely certain they will, because we can't stop them. We might want to stop them, but we can't stop them. Then demand for copper, demand for things like tin, all these base metals, I think is going to drive the prices up. And then on top of that, we've got the problem that the purchasing power of our currencies is sinking. I mean, we think we've got inflation, but actually it's not prices rising, it's the purchasing power of the currencies going down. But I tell you one thing, when people finally realize that that's what's happening, then these currencies are dead because they're not anchored to anything. Anchor them to gold and you're okay. And I think that's probably the direction in which Putin's Russia is going. I mean, let me give you an example. If Putin tied the ruble to gold, interest rates for 1 year rubles would drop from around about 12% down to somewhere between 2 and 4% over time. Now, what's not to like about that with a stable currency? There are very good reasons for them to secure the value of their credit by tying it to gold. And furthermore, Sergei Glazyev, who's one of the senior economic advisors to Putin, wrote in an article in a magazine called Vedomosti, which is, I suppose, the equivalent of the Financial Times in Moscow, on the 27th of September, and he said pretty well what I'm saying. He said, we've got to tie the currency to gold. He is also the man replanning the Moscow Gold Exchange following being cut off from the LBMA. So, there's quite a lot going on in gold in Russia. And I think that, the problem is they can't just rush out and say, right, we're going on a gold standard. Because that would probably lead to World War III. It would be a very aggressive financial act. But on the other hand, if the dollar starts collapsing, if the euro starts collapsing, then it's a defensive move. And it makes it very, very hard to criticize Putin for defending his currency in a crisis. So I think that's the thing that's going to give us the timing on that story.
Alasdair, thanks for speaking with Kitco.
That's very much my pleasure, Michael.
My name is Michael Macleod here at Deutsche Goldmesse for Kitco Mining.
Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Defiance Silver.